Alright, yo, what is up, guys? In today's video, we're going to be going over a comment I have received. Basically, the title is how to confirm if a market structure shift is valid, how to frame a trade idea, or use a market structure shift to frame a trade idea to confirm. So we're going to go over the comment first. So it says, because when market structure shift in 5 minute, so the 5 minute market structure shift targeting external resistance liquidity, or using external resistance liquidity for a market structure shift. And then when you check the 15 minutes, tap into a fair value gap, most likely hitting a stop loss. So I don't know if you're entering directly off of the market structure shift. Market structure shift usually confirms that the move is happening in the direction that you want it to. So if we have a market structure shift and the high is being broken through, and we close and then we retrace, that's where you enter. You don't want to. So let's show you. This is kind of the market structure shift. So this is the high, external resistance liquidity. We come back down, internal, and then eventually we break through that high and we retrace, we enter right there, and then we rally higher. That's kind of the trade idea you want to have with a market structure shift like that. And you want to have a fair value gap right here. Hopefully this is what you're doing. Hopefully you are entering right here instead of right here, you know, directly off of a market structure shift. You want to wait and then do that, because if you measure the premium and discount, of course, or you can do OTE, you can do an OTE entry, wait for OTE to be hit, and then you enter, and then boom, you have that. And that is pretty much, you know, how you frame the trade idea. Pretty simple. You don't want to use market structure shifts directly to enter, because then eventually what you can have, that it can just run right through it, but then close inside of the fair value gap, and then eventually just rally up, take that out, come back down, and then rally back up higher. And that's pretty much what can happen if you have your stop loss, or if you enter directly off of market structure shift, I should say, not your stop loss. So if you enter like down here and you have your stop loss down here, the fair value gap low, you pretty much would have been correctly in the move. So this right here, you're targeting external resistance liquidity. These two are your levels. This is your external high, and this was your external low. You see that? Broken through, market structure shift. What do you want to use? You want to use this, your OTE entry. You can see it comes and it taps into OTE. You have a stop loss at the most recent high from the market structure shift, and then eventually you target like a 1 range, or a anything lower than that, I guess. Anything lower than that would work too, you know, 2.5. So yeah, that's pretty much how it works. All right, so this is an invalid market structure shift. So you have your most recent lows, boom, they broke through. You have your high up here, pretty much. This is your high, and you can see as soon as you have that market structure shift, you can use the OTE, and you use the OTE, and then you enter, boom, and you eventually get stopped out. You're wondering why you got stopped out, and majority of the reason for that is because you have to look left. You have to look left. You have to see this price telling you. You're not going to just strictly rely off of a market structure shift or a 15-minute fair value gap. You're going to want to see sell side, boom, swept. Higher time frame order flow is telling you what you are bullish. If you go down to the daily, or if you go up to the daily and the weekly, you are bullish. You're going to use a higher time frame draw on liquidity, daily / the weekly. And then you're going to use OTE with market structure shift. And then you're going to see the dealing range you're in. Pretty much like the OTE, like the high and low, basically what we displayed here. Old highs and old lows become inverse. And, you know, this could be a 15-minute to 15-minute fair value gap here. A order block on the 15-minute too. But if you use your dealing range pretty much from that high to that low, you're going to want to be buying what? In a premium, or you're going to be shorting in a premium, I should say, not buying. So anytime you go above in a premium or this level up here, you're going to want to be, of course, short selling, since you had that external range right here being broken through, and then eventually we started retesting it multiple times, because it's basically an order block, and you're going to want to have your stop at these highs, or this one up here. You can have it at the most highest high, and you can just see price wanted lower prices, and you got that. You never got down there though. You could have just used a 1. That was a 1 to 3. So yeah, you want to use OTE, dealing range, pretty much your high and low of the range, your external ranges of liquidity, and pretty much you never got that retracement, so you're gonna have to miss some moves, in my opinion, if you don't get that. Yeah, you're not always gonna catch every move. This could have been your market structure. So he's targeting 5 minutes. So this is kind of something you don't want to do. You can see order flow is telling us why we are bearish, and you're going to want to use other things into consideration other than just a market structure shift to enter the trade. You want to use the market maker X model. You want to use a top down approach. You want to use OTE. You want to be measuring the order flow. You want to be using time elements. You can even use SMT divergences, power 3. You want to use other things to confirm a trade idea. You don't want to strictly enter off of a market structure shift on the 5 minute, targeting external ranges of liquidity, and then you see that, and then boom, you get the market structure shift on the 5 minute, but then it doesn't work out. So a market structure shift can either become a liquidity sweep, or it can become an old low that can be used to push price lower, or it can become a retracement after you have that market structure shift. Either 1 or 2 case scenarios. So right here, boom, boom, these were two ranges. As soon as you break above this right here, and then you create another external range right here, and this is your internal now. This is pretty much a OTE entry, so you can draw that out. And as soon as it comes to the 62 level, you can pretty much take a trade. So anywhere around here, or anywhere just inside of a discount. Of course, the R to R won't be the best, so that's why I kind of recommend the 62 retracement level, or the 75, 705, 7005, and then just target 0.277 level. A good trade. If you are using just a 5-minute only, of course, you can use other time frames. Okay, so premium discount inversion arrays, you won't always have a market structure shift available to take a trade. Like this could have been your market structure shift and you fell. Market structure shifts, they're old highs and old lows, and pretty much in the PD array matrix, any array could become inversed. So a breaker could become inversed, a market structure shift can become inversed. It could be a liquidity sweep and then pushes price higher, or it can rally up above the market structure shift and then retrace down because it's using it as an old inverse level. Order blocks can become inverse fair value gaps, inversion fair value gap. Don't you see this right here? Inversion fair value gap. It became inversed, and then pretty much, and then this right here became inversed and it rallied higher. This would have been a breaker, pretty much. Old highs and old lows can become inversed right here. I'm just explaining it to you very nicely. This order block right here didn't hold. This order block right here, this up close candle, it didn't hold. We rallied up, and then we rallied below it. I would want to see price hold that, like it right there, and then eventually ran right through it, and then eventually used it as an inverse, and then it rallied higher. Simple as that. PD arrays can become inverted. Market structure shifts can become inversed. If your market structure shift is not holding or invalid like this, guess what? It became inversed. It wasn't a market structure shift, and you're gonna have to frame your order flow. And the order flow is changing since PD arrays are being shifted. So always want to keep that in the back of your mind. Inverse PD arrays. If you're always targeting external levels, you can see your market structure shift sometimes won't be fully valid. You can see it right here too. That internal market structure shift was far more valid than any other one. And then this is your PD array, your new premium and discount. Your dealing range. So you had that market structure shift. You created a new dealing range, and this became a market structure shift. You don't want to enter strictly off of this. Again, use OTE. Why not use OTE? You can see that perfectly fine right here. It came and it tapped into this level of OTE, and you're going to want to use your dealing range with OTE and market structure shift. So this would be your 5-minute market structure shift of an external resistance liquidity run. And then you want to have your premium discount inverse arrays. So this could be a premium and discount inverse array right here. This could be a balanced price range, and then pretty much you can see price tapped into it, and I think you have a breaker here too, a breaker. So that was even more high confluence. You can just see price came and tapped into it, and then it dropped. Another one would have been like this. Pretty much this is your external range of liquidity up here and then down here on the 5-minute. So as soon as you see your market structure shift right here, and then you can see pretty much a new dealing range was created. Since we never broke above these highs, but we broke below that low, a new dealing range was created because we're not going to reach up here. If price broke these lows and it had a confirmation lower, and order flow is telling you what you are bearish, you retrace up a little bit and then you drop. That is telling you what you are bearish and you want to seek lower prices. So you want to use what? OTE, and pretty much it held pretty much perfectly, pretty nicely. So it would have been your confirmation tool right here. Stop loss above these highs, and then you want to just target 2.6 level. 27 level, and you can see that you got that right there. You're always going to have a new dealing range on the 5-minute, since external resistance and internal is pretty low on these levels. External ranges can be created anytime, in my opinion. It becomes inverse, like I said, but you want to have the higher time frame drawn liquidity for sure, the daily and the weekly. You always want to have that in the back of your mind. You can use OTE with a market structure shift to confirm it. Market structure shift is pretty much a just a retracement tool, in my opinion. So you also want to use time elements. You don't want to just strictly enter off of each market structure shift. You want to see if you're in a session. I recommend trading sessions only, like a PM session, AM session, London session, Asia sessions, and you want to follow the higher time frame drawn liquidity no matter what. You had an internal market structure shift right here from this external high. It got broken through, so this was your external and this was your internal. You see we broke through that high. We created another one. You don't want to strictly enter off of that. You never got a retracement, so you don't want to be entering strictly off. You want to wait for that retracement, catch the retracement. You can see perfectly soon as we come back, we drop, and then eventually rally. You want to catch this type of trade right here. So that's pretty much all I got for today's video to confirm a market structure shift on the 5-minute external ranges of liquidity. You want to use OTE. If you don't find an entry, that's good. You're not putting risk on the table. And if you do, you want to follow the higher time frame drawn liquidity, and you want to see if you're following that higher time frame order flow. Following the higher time frame order flow by far is more important than finding a market structure shift on the 5 and the 15-minute. That's pretty much all I got for today's video.